Good morning, everyone. Can everyone hear me okay? And can you also see this screen? I'm sharing my screen here and hoping I'm not going to miss people logging in, but I wanted to at least share my screen here so I can share some of the information that I've been receiving from my world of real estate. And for those of you who don't know me, my name is Dean Otto, and I've been a real estate broker in Kapalua for the last 33 years. So I've been through a lot of the ups and downs. Are you there? Sorry. So just wanted to take the opportunity to share some of the knowledge and information that I'm receiving. And as I mentioned, I work for Keller Williams, and I was fortunate enough to get a strong ranking in the Keller Williams world and got me into a group of the top 100 agents, which means that I go every quarter and I spend 2 days with Gary Keller, who is probably one of the most influential people in real estate right now in our country, and spend 2 days with him every quarter going through the information that I'm going to share with you now. I'm not going to go through the entire 85 pages, but there are some highlights that I would like to select on to share with you guys. Let me just make sure I'm not losing anyone here. Okay. Here we go. Let me just get to the first page. So what I'm going to do is take a look at the national trend and sort of go from national trends, which basically lead the way, that the individual markets react at their own pace, but ultimately they all end up in the same place at the end of the day. And I think this first chart that I'm showing you right now, which is a trend line for actual sales taking place in the entire country. So it's the largest group that you could possibly study. It doesn't distinguish between price or anything else other than just the total sales per year in the US. And it's an interesting stat because it's such a big one, but it also shows some interesting trends. And I think that's what this chart's shown me, and what the recent information shows us, is that we're on very, very definite and very consistent 15-year cycles between peak to peak cycle, right? So if you look at the history of this chart, you'll see 1990, which was our last peak. So 1990 through 2005, and then 2006, 2021. And those are ultimately the two last cycles we've gone through, both exactly the same, both 15 years in length. And there's a lot of similarities, maybe some similarities that I want to point out. The purple line going across the page is the current 2023 pace of sales. So you can kind of see where we are in comparison to history. We're at the same pace of 2008 after the market crashed, and going all the way back to the 90s as well. And this is a pretty consistent cycle. And if you look at, there's a couple of things to point out. 2005 was our previous peak market. And then we started to tail off at 2006. But the drop between 2006 and 2007, $1.5 million sale drop, the biggest drop in the US history, in the history of the US real estate market, is the biggest drop from one year to the next. And that the second biggest drop is the 2021 to 2022 drop of 1.1 million. So those are the two biggest drops in the history of the US real estate market. And what's interesting is that after that drop, if you go to 2008, which is where the significant change happened, 2007 to 2008, and then again in, let me just get someone in here, and then again from 2021 to 2022, those are the biggest two drops, right? So if you follow the trend following the drop, there's a 7-year period, 7-year trend that's consistent over time, that on a 15-year cycle, the first 7 years are slightly declining and flat. And then the appreciation occurs from year 8 to year 15, which shows in the previous 1990s to 2005. But if you take a look at 2008, 2009, 2010, 2007, and then you look at 2022, exactly the same. If you look at 2008 and you look at 2022, exactly the same. And if you look at 2009 and you look at the projection for 2024, it's identical. So our last 3 years are following the identical trend that we followed in the previous cycle, which was the peak in 2005. To me, it's very interesting. I love statistics. Statistics don't lie. And if you think that history doesn't repeat itself, there's a pretty good example of history repeating itself again. And this is not the second time we're happening. This has been going on and on for a period of time. So, what does it mean for us in this particular real estate market? It means that if you look at 2007 to 2013, we're in the second year of the cycle, right? So 2007 was the first year, 2008 was the second year, 2009 was the third year. So we're in our third year of this new cycle. And it looks like it's consistent as it's ever been. The numbers are identical. And I think that it gives us an idea of what the next 5 years look like. And we're looking at 2007 and then 2008, 1, 2, 3, 4, 5, 6. Ultimately, if you go 7 years from 2007, you'll end up in the same place, right? So I guess the conclusion that we come to from that is that if you're ever thinking about selling in the near term, that you're probably the most likely to get the best price sooner rather than later. And that as we go into year 3 of a 7-year cycle, we're not expecting to see any appreciation really for the next 5 years. We're not expecting to see a major drop, but we are expecting to see flat to slightly declining next 5 years based on the historical trend, which has been very consistent over the years. And this is a pretty good indication of it. This first 2007 to 2013 is what we're looking at now for the next 5 years. And our 7-year cycle, which we're in year 3, and the 3 years are absolutely identical to the penny, to the number, as we've recently gone through. So we feel pretty comfortable about our prediction of a flat market for the next 5 years, and that appreciation beginning again in 2028 is really what we're looking towards. Let me just zip down here for one more slide here. So if you look at pricing, which is the other part of this, right? This is a really interesting chart as well. And it really is pretty interesting because there's a couple of things going on here. You can see the major bubble in 2005, 2006. 2005 was the peak in the market, but look at the average sale price, still continued to be strong for 2 more years after we hit our peak. And if you look at the end of the right side of the chart, you'll see 2021 was our peak, but our pricing is still really strong. Right? And there's this period of time after we pass a peak where it takes for the adjustment to kick in. And as I mentioned earlier, all markets react differently. Our market is slow to move, slow to react. We're not having as many transactions right now, so it's a little hard to see where our market's going. But this is a really positive trend right here. And you can see why we feel like the downside to the cycle is not going to be very bad. It's going to be pretty flat rather than a major decline like we saw in 2009. And you're seeing a light blue line. That's what we call the 4% trend line. And the beauty of real estate is that real estate always goes up. And as long as you're willing to be a little patient, you really can't lose.
Recording in progress.
Uh-oh. Karen, that may be you. Can you mute yourself? So what we're looking at here is the difference between the previous peak and the results of that previous peak, which was that subprime lending fiasco that really created a bubble that burst and resulted in a major decline in pricing, as you can see below the 4% trend line. The 4% trend line goes back 100 years. Our real estate market in the US has gone up consistently every year over the last 100 years, 4% a year. And it's very consistent. Markets react differently, but we always end up at the same line, same place, and the pricing always gravitates back to the 4% trend line. It always has, and it always will, apparently, unless history is changing here. But what's important here is to see in 2006, we were 24% above the 4% trend line. That is probably way too much, and it was artificially inflated through subprime lending, which basically meant that anyone that could fog a mirror could get a loan. And all of this influx of credit into the market is just too much for the market. And ultimately, we had a good couple of years there, but you can see the downside from 2008 to really till 2021. We really didn't catch up to the 4% trend line. And that's because of the bubble created by 2005, 24% over the trend line. It hurt, right? So It hurt us because we went too high, and that resulted in a really bad downside. But if you look at this, it's really interesting to me is, the question I get is our real estate overvalued? And the truth is that it's not overvalued. We're actually only just caught up to the 4% trend line in 2021. So between 2008 and 2021, we were below the 4% trend line. And that to everyone in the real estate business means that we're pretty substantially undervalued up until 2021, which is when we finally caught up to the 4% trend line. So the good news is that we're not overpriced. We're actually within a range it's very acceptable, and a range that actually is a fairly strong market for what we're going through. You can see here, 2024, the prices are expected to be even higher than 2023. Now, this is overall, remember, this is the US market, right, overall. But it's an interesting situation because you can see the 4% trend line is really kind of shaping up to be meeting the average sale price probably in the next year or two. So we're expecting maybe just a slight softening of the market for the next couple of years. But really that after a couple of years, hitting the 4% trend line means we're going to flatten out. And we're actually looking at a rather flat to slightly declining market for our first 7-8 years of our cycle, which normally is where we result in the correction of the market and the adjustment of pricing, which you can see in 2008, 2009, 2010, all the way. That was where we're sort of struggling to get back to what's considered to be the typical appreciation over the history of real estate. So we're not overpriced, in my opinion. We're only just catching up to the 4% trend line. Prices are still very strong. And really the strong pricing is primarily a factor of lack of inventory. So the markets that are kind of hanging in there past peak in 2005 and still showing some pretty strong pricing are really driven by lack of inventory. There are markets that have seen corrections and adjustments. The markets that were very strong early, like Austin, Texas, and some of the other markets are down already. But the markets that are still catching up, are still hovering around historical high pricing, even though we know we passed a cycle in 2005. So that's actually pretty good news. And the 9.3% above the trend line is a good number. For a peaking market, that's manageable. You can see the trend line is fairly close, so we're not expecting a major adjustment. And it's a very different peaking market than it was in 2005 and 2006, as you can see from this chart. That kind of tells a lot of the story right now. Volume is a good one to look at as well because it confirms the trend that we're talking about, which is a peak in 2005 and a peak in 2021. So even though the volume is slightly down because of less transactions, pricing is still pretty strong. And I think that's actually a pretty good market for us to be in right now. And let me just go to 11. Inventory is obviously driving our world. We consider 6 months a healthy, balanced market. And that blue line that you see going across the screen is the 6-month line. And you can see that we've been way below our 6-month typical, what we'd like to see inventory since 2012. So we've been battling low inventory for some time now. And you can see that inventory is creeping up. In 2023, 2024 is going to be a little higher, and we'll eventually get back to the 6-month trend that we would like to see, which sort of balances our market out. And I think ultimately pricing is a function right now of this lack of inventory that's pretty much across the country. Let me see the next page. Mortgage rates is obviously the way that the Feds control our economy and our real estate market. That 4% trend line, the Feds are really going to keep interest rates where they are, at least at this higher price, until we hit the 4% trend line again to get that pricing back to normal again. And I think we got a couple more years, if that's the case. Basically, looking at that 4% trend line means we probably got a year or two before we're going to meet the 4% trend line, which means that in a year or two, we may see some relief on interest rates. But for right now, we're looking at between 6 and 7%. And if you look at this chart here, the 50-year average is 7.74%, and the 30-year average is 5.98, call it 6%. So, we're right probably where we need to be. I know people struggle with interest rates because it's a big difference for a lot of buyers in the market. Interest rates for most of us realtors are not a concern. It's sort of the lever or the throttle that controls our economy, and we need balance in our market to sustain a healthy economy. And so interest rates, from my perspective, really only control how much you spend. It's not a question of whether to buy or not. It's really just an adjustment on you can't buy as much with the higher interest rate, but it doesn't mean you shouldn't buy. You know, I see people all the time now backing out of buying because the interest rates are high and renting. That's, of course, you always tell people that, you know, if you're renting, that's 100% interest. So since you're not getting any of it back. So we're trying to get people to the comfort level of 6 to 7% is going to be the normal interest rates for the short period here. And there may be a slight dip into the fives, but we're not expecting to see 3% financing anytime soon. I'm going to skip forward a little bit here because this report goes into Canada and all kinds of interesting things. And I want to skip some of that unless we have any Canadians on the market. I'd be happy to connect back with you and go through the Canadian version of these statistics, but they're very similar, by the way. So this one here goes to GDP. We're talking a little more economy now. And so I think that GDP is an interesting trend because GDP is really an indication of consumer spending. So sort of while you want to see consumer spending, you also don't want to see consumer spending up to this 5.8 number because that's what results in inflation, right? So the manageable GDP is probably 2%. And anytime we go over 2% and up to 5.8, that's just simply too much and causes inflation. And that's what causes interest rates to go up to get these numbers back down again. Let me see, 23, 26. Employment is always interesting for me because it tells the story. I mean, we had 3.6% unemployment for the second year in a row. That is the lowest unemployment, as you can see, for the last 50 years, as far as I can tell. And so we're at a really great place in unemployment as far as economy goes. And actually, that's almost too low. Most economists will say we almost need a little bit more than that because ultimately there's a lot of people switching jobs, people moving to other jobs, moving to other places, getting new jobs. And that sort of accounts for about 3.6%. So we really have very little unemployment right now, which we're feeling on Maui, feeling at our restaurants for sure. But there's obviously a major shortage of employment. And it's not just that people don't want to work anymore. There's a lot of switching of jobs. There's a lot of people getting out of some of those industries that they don't want to be in anymore and switching to other jobs. And we're seeing a lot of disruption to this unemployment numbers, but those are pretty strong numbers. Inflation is obviously the big determining factor in how we control our economy. You know, obviously when inflation gets up to 7%, that's a problem. And the Feds have been absolutely committed to driving that number down to 2%. And at any cost and every cost, they're willing to do whatever it takes to get inflation down to 2%, because that really is the number we need for the healthy economy moving forward. And you can see that so far we've done a pretty good job. We're down from the 7 to 3.4. And I think we're currently running at about 3.5.
3.5.
Yeah, but I think ultimately it's still a little high. And I think that they're still going to drive that number down to 2%. And it kind of lines up with the next couple of years of interest rates staying where they are to get this number down to 2%, and also to get the pricing back to the 4% trend line. That's really the goal of these interest rate hikes. 31, let me see. Oh, this is just interesting. I threw this out there because it's kind of interesting. It shows inflation and affordability over the last, since 2000. You can see where a lot of our appreciation has occurred. Obviously, medical world, hospital is appreciated 238% in 20 years. Crazy. College tuition, textbooks, healthcare, childcare, wages. Real estate's kind of right in the middle there, actually. So I feel like that's a pretty good place to be. It's middle of the road. It's not outrageous. It's reasonable. And I think it's fair. If you look at some of the things that have really gained on, TVs, toys, computer software, I mean, TVs are 100% less than they were in 2000, which is crazy. I don't know how that works. But it's ultimately an interesting statistic that I just enjoy. So I thought I'd include that there. So that's sort of like a little bit of the national level real estate. And I think that ultimately we are looking for exactly what they've been doing and being consistent with what they've been doing, because ultimately they seem to be a pretty good situation. The economy is doing really well. and they're trying to cool off the economy to catch up with inflation and everything else that's just a little bit out of control. So we're in actually a really good economy, and it's very healthy. And I think the real estate market is actually pretty healthy as well. And we don't have any major complaints here. So let me just get out of this, and I want to get down to the next stat, which is Maui. So I pulled this little stat for Maui. This is kind of an interesting one too, because as you look at it doesn't feel like if you're an agent in the market in Maui right now, it doesn't feel like the real estate is going as well as the statistics show, which is actually pretty good news, right? You look at residential and condos, and I'm going to talk mostly about residential and condos because vacant land, for the first quarter of this year, there's really not enough sales to get excited about trends in vacant land. You have regions that have 5 or 6 or 2 sales of land, and it's not enough to really focus on at this meeting. And if you're a landowner and want more information, I'd be happy to meet up with you separately. But if you look at the residential and condominium sales on Maui for the first quarter of this year versus the first quarter of last year, like home sales are up 8%, median price is up 13%, volume slightly down, but that's really just a function of the price of the properties that are selling are slightly lower. But ultimately, that's very positive. Condos as well, up 3% in sales, up 4% in price, up 13% in volume. I mean, that's looks like actually a fairly strong market, right? And again, I don't think there's anything here that's to be concerned about. I think we're actually in a pretty good place. We're comparing to last year, which maybe wasn't quite as good as the year before, but we're holding steady. And I think it shows this idea that the next 5 years will be flat, sort of a flat, slightly declined, but very flat market for the next 5 years. And we're sort of hanging in there with statistics that are sideways right now. So unless something changes, we're looking pretty good right now. And I guess the major threats that could change this would be a few things. I mean, for us in Maui, insurance is a big issue right now. And one of the things we're really struggling with, and a lot of our condo complexes are having a hard time with, I've heard of condo complexes insurance going up as much as 800%. So it's a concern right now. We are seeing maintenance fees going up in condo complexes. And I think that that's something that's going to take some time to work through. I was selling real estate in 1992 when Hurricane Iniki hit Kauai, and it became really difficult to get hurricane insurance during that time. It does pass over time as things stabilize and get back to normal, but for the next couple of few years here, it looks like insurance is going to be one of our biggest challenges, and something that we all need to be paying attention to. The other one is politics. And we have a really tough time with politics right now, especially in Hawaii with
YouTube, but I need to do that.
who's
To
that?
have
Someone needs
provide
to
estimate
mute. Someone needs to mute there.
of how you, where your down payments coming from, income
Hello.
for this to qualify. And we do also have to request a credit report.
Hey, Laurie, I think that's you. Can you mute, please? Oh, I just muted her. So yeah, so our biggest challenges are insurance, politics. There's a lot of politicking going on right now, and politicians telling people what they want to hear, but distracting us really from our real issues. And of course, the threat of war is a big one, right? I mean, obviously, there's escalation going on right now that we're concerned about, and that always going to have an impact on every market. Separately from those items, we're in a really good space right now. And while we're not expecting major appreciation over the next few years, our prices are crazy high and historically very high right now. So if we were able to hold to these prices, we'd be doing really well. Because if we hang in there for the next 5 years, we're looking at appreciation after that. So we're not expecting a major downturn, and we're expecting a sideways market. This information, I think, to some degree justifies that. Interesting, this chart over here, this is a side note, I guess. This is the conveyance tax for the state of Hawaii. So every time you sell a property, as a seller, you have to pay the conveyance tax. And here's the numbers below. What it translates to, if you were selling a $3 million house, that's an $18,000 conveyance tax at closing. If you were selling a $10 million house, that'd be a $125,000 conveyance tax at closing. It's a pretty big one. It's a sliding scale. So typically, obviously, dings the more expensive properties more. But that's a little bit about be prepared if you're selling a property that there is this conveyance tax. And it ranges, as I say, for a $3 million sale around 18,000. And it's a sliding scale. Let me go to the next slide here just to show you. If you talk, we want to talk a little bit about the regional, the regional market in Hawaii and how what the impact of the fire, a Lahaina fire, is on our market. I think that's a question we get consistently, and I thought this chart really is probably the best way to describe it. And again, as I talk about this, I'm going to eliminate the sales of lots, which is the very bottom portion of those different sections, because as you can see, some of these regions are only having 2 or 3 land sales. So let's avoid that for now. And let's just talk about home sales. And if you look at home sales, Central is up pretty substantially. North Shore is up pretty substantially. Hana doesn't get a whole lot going on, but they've had a good sale over there. Upcountry is up 21% in sales. And the south side is up 16% and 17% in dollar volume. So really, it's really only the west side. This is the good news and the bad news, right? So the west side is lagging, sort of in a stall right now, because, obviously the direct impact of the fire is on the west side, right? But the good news is that the rest of the island is actually doing quite well and not really necessarily being that negatively impacted by the fire. So to me, it's good news. It's good news that the Maui market is not being dramatically affected. There's still transacting going on. There's still some pretty strong sales, maybe not as expensive, but there's still a lot of strong sales going on. And it's the impact of the Lahaina fire is fairly isolated in the West Maui market, which doesn't sound like great news for us West Side people, but it does give me the confidence that it's just going to be, we have to be a little bit patient on the West Side to get through this initial, it's just a lot of emotion, a lot going on right now. And I think if we get past that, we're going to be fine, because the rest of the island is doing just fine, is my take on this chart. But I think everyone is asking me what the impact of the Lahaina fire is going to be. It is now and will be. And I think that this chart shows that it's pretty isolated right now. And I think we feel pretty good about the fact that the rest of the island is doing pretty well. So skipping over to Kapalua residential. So the not so great news for this first quarter of 2024 is that we haven't had a closing of a home in Kapalua in the first quarter of this year so far. We do have a couple houses pending. One that's been pending for 389 days, so I'm not quite sure about that one, but we do have a Pineapple Hill house pending right now. It's don't be freaked out if you see a low number there. It's $3.3 million is the pending sale in Pineapple Hill, but it's a much smaller house. It's one of the very few smaller square footage homes. So if you look at the price per square foot at almost $1,400 a foot, it does fall in line with the other listings that we have on the market, which range from $1,400, $1,300. So, it's consistent in its price per square foot, but it's a smaller home. So challenge for a real estate broker is going to be, the only sale this year has been 3.3 million. And it's on us to be able to get out there and explain to the market that that's a smaller house with less view, but it does meet the price per square foot standard that we're applying to all the other properties that are on the market. So that's a little bit of a concern, the lack of activity. But again, I think it shows that bit of a stall on the west side, but nothing that we're too freaked out about, because, as I say, we are seeing sales happening on the island. And I think to me, it's just a cooling off period and a stall while we work through some of these items that we're faced with right now, which is cleaning up lots and getting everything back on track on Lahaina, which, by the way, is going quite well. We did get the latest news that the cleanup of the lots in Lahaina is going really well, and it's ahead of schedule. So the understanding is that all of the lots in Lahaina will be cleaned by the end of this year. And that was originally anticipated to be 2 or 3 year process. So they are making really good progress on that part of it. And we're just scrambling to get to a point to where people can start building again, because so many people are ready to get going. And it's never quick enough, but to getting all the lots cleaned and cleared of all the toxic materials and all is obviously phase 1, and that's going really well. Let's see here. Let me go to Kanapali just to show, actually, let me go to a couple of condos just to show there's a little more activity in condos. So what is happening here is inventories are building up. And I didn't point out on the last one, but the days on market is increasing as well. So while we're seeing really strong activity in Maui still, we are seeing that inventories are building slowly but surely, and days on market is going up slowly but surely. So this transition is really sort of gradual and at a really good pace, and I feel pretty good about it so far. Condos for sale. We do have a nice little run of activity. It's been a little bit slow, but there's some pretty strong sales here, as you can see. Pending sales, 2.9 million for a ocean view bay villa that's not on the water is actually a really strong price. And the Ridge 1723 at the very bottom of that page, 2-bedroom, 3-bath Ridge villa, that's closed for 2 million, 2.8 million. Those are all historical high prices. The previous high for a 2-bedroom Ridge villa was 2,225,000. So again, there are people that we know one thing for sure, and that the demand for Maui is still very strong. People love Maui. There was an incredible amount of support that we received from just random people who just have this greater draw and love for Maui, and that's not going away. So we're still seeing a fair amount of interest and demand for the property. It's just not everyone's jumping into the market yet because there's some hesitation. There's a lot of negative media out there. There's a lot of reasons why people are choosing to hold off and see how it goes for a while before they jump in. But it is what it is. And let me just see, there's a couple other condos here I wanted to point to. Look at this Montage sale for $12 million. So even when, you know, we've sort of challenged, we still see people coming and paying some really strong prices. Not as frequently, but as I say, there's still people that are in love with Maui and have no intention of not coming back. Right? Kanapali has also been a little quiet, and we have had some sales, but residential in general is just slow across the west side. And you know, the only thing of note in this Kanapali CMA is that all of the sales that have happened this year have all been less than $3 million. And as you can tell from the listings, we have a whole bunch of stuff in that $4, $5, $6 million price point, but the focus has really been in the 3 million and less, because a lot of these purchases are purchases who have lost properties in the fire, received insurance money, and are reinvesting. So we're seeing a pretty strong cap in interest at about 3 million. We are seeing some really strong sales out there sporadically, like a 12 million at a Montage, but generally there's been a little bit of consistency in that $2 to $3 million price point. And then the Kalapali condos is interesting too, because this is where we're seeing a lot of new inventory coming on the market. This is amazing. I mean, that's a lot of inventory for Kanapali versus Kapalua. And they always do have more, but there's definitely a buildup of inventory going. But look at all the pending sales as well too. These are all fairly recent sales. So we're pretty positive about what's going on in Kanapali. These numbers are pretty good. And it's showing some interest in getting back into the market again. And these are the sales in Kanapali since the beginning of this year. So actually not bad. There's some Honua cars trading in there. No really huge numbers again in there. I'm seeing nothing over 3 million again. So again, focus on maybe Lahaina buyers, people who lost properties, wanting to find replacements until they can rebuild. And then last but not least, Lahaina residential. What's going on there? Same thing, you know, same thing in Lahaina, a little build up inventory. We are starting to see some pendings. There's some pretty nice sales in there. There's a 3.7, but ultimately it's fairly consistent in the 3 million less, although you will see a couple sales in the sales department down there, one for 5 million. And so there's some activity in Laniopoko too, which is encouraging. The properties that are selling, obviously the properties that are well priced. We're not having great success with inflated listings with ambitious pricing. And that's really what's sitting right now. But if